Today, we are taking a scalpel to a single, highly provocative piece of research. It's an analysis report focused purely on the maximum bullish outcome for AMC stock. Our mission is pretty simple, but I think essential for anyone tracking this space. We need to understand the data, the structure, and the logic that supports this high-end analyst prediction. A prediction that sees a staggering 188% upside through 2026. We're really just trying to cut through the market noise here and pull out the financial nuggets that inform that massive price target.
Exactly. And this analysis, it really centers on a fundamental disparity. The market, as a whole, has been pricing AMC like a distressed asset, like it's destined for bankruptcy. This report argues that the underlying operational data, well, it now points to a dramatic turnaround. It makes the current stock price a massive mispricing error. We're exploring the shift from a survival story to a growth story.
And the core thesis that really anchors this entire deep dive is a direct quote from the analysis. The bankruptcy bear case is dead. The recovery bull case is here. To buy into that, you first have to grasp the scope of the opportunity being outlined. So let's unpack that 188% figure itself.
Right.
This number isn't just pulled out of thin air. It defines the chasm between the current depressed trading price, which the analysis puts around, what, $1.64?
Yeah, about $1.64.
And the most aggressive, high-end analyst price targets for 2026, which soar up to $4.72. That's the potential return if this bull case plays out perfectly.
And that gap is defined entirely by the perception of risk. I mean, Wall Street analysts have long maintained a consensus rating of hold, mostly because of the sheer volume of debt on the balance sheet. They couldn't just ignore that ticking clock of debt maturity. But if you look closely at the price targets being issued, especially the outliers, like that $4.72, these analysts are already modeling a successful, dramatic recovery. The market is pricing the company based on its past debt stress. The bulls, they're pricing it based on its future efficiency and the box office rebound. The real insight here, though, is how the analysts are forced to value the company.
That's where it gets interesting, isn't it? If the company was facing imminent bankruptcy, analysts would be using distressed asset valuation metrics. So how does the survival thesis shift the fundamental financial lens they use?
It's a key methodological pivot. It's a huge shift. When analysts fear a near-term default, they'll often value a company based on its adjusted EBITDA multiple. It's basically what someone might pay for the stripped assets.
Okay.
But if you remove that immediate threat of insolvency, the model shifts dramatically. It moves to a discounted cash flow or a free cash flow valuation. And that FCF model immediately captures the future profitability of an efficient, stabilized business. That's what gives you these much higher targets.
And that shift from valuing assets to valuing future cash flow, well, it only works if the company survives the next few years. So let's dive into the first critical pillar the analysis provides. Pillar A, survival is secured. This is the death of the immediate bear case.
For years, the major bet against AMC was that debt maturity wall, specifically the massive repayments due in 2026. This was the ticking clock short sellers were counting on to force a catastrophic restructuring or, a collapse. The analysis highlights the mid-2025 transformative refinancing deal. They successfully pushed billions in debt maturities out of 2026 and into 2029 and 2030. That move bought them 3 to 4 years of operational freedom.
But I have to play the informed skeptic here because this is what critics will say. Isn't extending debt just kicking the can down the road? I mean, the debt burden is still there, just later. Does the analysis address that argument, that this hasn't solved the core problem?
It absolutely does, and this is the crux of the bull argument's defense. If you're betting on a cyclical industry turnaround, like the box office, buying 3 to 4 years of time is transformative. It's not just a delay. It shifts the company's focus from crisis management and survival to optimization and maximizing returns ahead of that 2026 supercycle. And critically, it removes the pressure for immediate, highly dilutive equity offerings, assuming the box office recovers as projected.
That's the real significance for you, the listener. Time is currency, and they purchased enough time for external conditions to improve drastically. But survival is only half the battle. We need to look past simply surviving to how they've actually optimized the business. And that brings us to Pillar B, operational efficiency.
Right, and this is the argument that fundamentally counters the basic doom and gloom narrative, the one that simply cites lower attendance compared to 2019. The market is focused on that top-line attendance number, but the bulls are focused on the bottom-line efficiency.
Okay, so what does that look like?
We're seeing a monumental increase in the revenue generated from every single person who actually walks into the theater. The analysis provides the key metric. Revenue per patron hit an all-time record of $12.25 in Q3 2025.
$12.25.
Yeah.
That figure is striking. To give the listener some context, what were those numbers like pre-pandemic. Because even a small jump in a high-volume business is huge.
Oh, it's a massive jump. In 2019, the average revenue per patron was significantly lower. It often hovered in the $9.50 to $10 range. That leap to $12.25 represents an increase of over 20% in efficiency. It means the company has structurally changed how it extracts higher value from every customer visit.
What operational changes are driving that? I mean, is it just the price of a Coke and a popcorn?
Well, that's a major factor given the high margins on concessions, but it's primarily strategic moves. First, pricing power on concessions, yes. Second, the massive rollout and adoption of premium formats like IMAX and Dolby Cinema. Those command significantly higher ticket prices but use the same physical theater. And third, optimizing staffing and overhead costs relative to the reduced attendance levels, meaning the remaining revenue flows through with higher operational leverage.
So they are maximizing their existing base. And speaking of dominance, the analysis points out they're also gaining ground on their rivals.
Correct. They're growing market share in a consolidating industry. AMC has increased its U.S. market share to 24%. That's up from approximately 22%. And that growth is happening while major competitors like Cinemark and Regal are struggling. It demonstrates that as the industry contracts, AMC is cementing its position as the undisputed leader in North America, which gives it long-term leverage.
Okay, so Pillar A secured survival, and Pillar B secured incredible internal efficiency. Now let's turn our attention to the external environment, which the company is now perfectly positioned to capitalize on. This is Pillar C, the 2026 supercycle.
This is the expected external revenue driver, the thing that transforms the stock from stabilized to growth. The analysis leans heavily on CEO Adam Aron's projections, which foresee the 2026 box office being dramatically larger than 2025.
What's the confidence built on?
It's built on a specific, known external catalyst, the post-strike stacked film slate. The industry suffered production delays during the writers' and actors' strikes, and the effect of those delays means massive tentpole blockbusters that should have been staggered across 2024 and 2025 are now concentrated into the 2026 release schedule.
We need to make this concrete for the listener. What kind of films are we talking about that constitute a supercycle?
We're talking about the major, high-grossing sequels and franchise tentpoles that define the industry's success. Now, we can't name specific titles that haven't been officially announced for 2026, but analysts are modeling based on the historical performance of delayed entries from major studios. So think sequels to mega hits or major entries into established cinematic universes that have been sitting in post-production, just waiting for this window. It's an artificially concentrated slate that creates a box office surge.
And the analysis points out that the momentum is already building, giving them a significant tailwind into that supercycle year.
Yes. Q4 2025 is tracked to be the highest grossing fourth quarter in 6 years. That means they are entering 2026 not just surviving, but already demonstrating revenue acceleration. If the supercycle thesis holds, that revenue will pour into a business that is operating at that $12.25 per patron efficiency. And that creates a huge surge in free cash flow.
So what does this all mean when we synthesize the survival, the efficiency, and these massive external catalysts?
The bull argument becomes robust. If the box office manages to return to even 80% of its pre-pandemic highs, which the stacked slate makes highly achievable, the current stock price of $1.64 is considered dirt cheap by the bulls, you're buying a highly efficient market leader at a bankruptcy discount that should now be obsolete, due to the debt extension.
That is the core fundamental investment thesis right there. Finally, we should probably transition briefly to the technical trading perspective that's in the analysis. It seems to support the timing of this buy the dip signal.
We've discussed the fundamentals, but the charts are confirming the shift in sentiment. The analysis highlighted that the stock price recently tested the critical $1.44 all-time low support level and held firm. Successfully testing a critical low and bouncing off it is a classic technical reversal indicator. It suggests sellers are exhausting themselves.
And that reversal was confirmed by volume, which is key.
Absolutely. The analysis cited a recent 13% surge accompanied by over 72 million shares traded. High volume on a bounce-off critical support is what analysts call confirmation of institutional buying pressure.
Why do analysts interpret that specific volume spike as institutional buying rather than just, retail traders jumping in?
Well, institutions require high volume to accumulate shares without dramatically affecting the price. And given the recent debt restructuring Pillar A institutional funds that previously had rules prohibiting them from touching a near bankruptcy stock can now re-enter the position, they see it as a safer, legitimate turnaround play. So that large, sustained volume confirms that sophisticated capital is validating the fundamental thesis we just discussed.
I see.
And for short-term traders watching the charts, the analysis also provides a roadmap for immediate gains. That strong close above $1.64 means that a move above $1.70 opens the door for a rapid price action known as a gap fill.
And a gap fill targets a previous trading range the stock fell out of quickly. Where are the targets for this immediate action?
That gap fill targets the $2 to $2.20 range. If the stock can achieve that, it validates the short-term reversal signal and provides the momentum needed to tackle the larger resistance levels, the ones that lead toward that high-end long-term analyst target of $4.72. The technical setup is now confirming the fundamental turnaround story.
This has been a complete deep dive into the framework supporting that 188% upside thesis. To quickly recap for you, the three pillars of the bull case are clear and data-driven.
First, survival secured. The debt extension out to 2029 and 2030 eliminates the immediate threat of bankruptcy, and that shifts the valuation model from distressed assets to a discounted free cash flow model.
Second, operational dominance. The company is highly optimized, evidenced by that record revenue per patron of $12.25. That's over 20% more efficient than pre-pandemic, and they're growing market share against their rivals.
And third, the 2026 supercycle. An external revenue tidal wave is expected from a stacked film slate, providing the necessary top-line growth to fully capitalize on that internal efficiency. Now, the analysis acknowledges this is still high risk, high reward, the debt is still there, but the immediate solvency risk has been dramatically reduced. That makes the $4.70 target a possibility. And this raises an important question for you to consider long after this deep dive is over. If AMC has secured years of runway, and if they are operating at record efficiency, generating $12.25 per patron right now, what specific percentage of a pre-pandemic box office recovery is truly needed for the company to generate enough free cash flow to justify that analyst's high-end price target of $4.70? Determining that critical recovery threshold, that's the key to validating whether this is merely optimistic or a deep value play.